markets.
I want to press on financials for a second, because if you look at the price to book to some of these names, though, they're trading right around the levels that we saw, say, even 10 years ago, when the 10-year yield was twice as high as it is now. Why the confidence?
Yeah. So I think on the financials, again, you got to be selective. But here's why I have so much confidence in financials. Probably the biggest driver for multiple re-rating is cash return. So we've noticed that as the payout ratio for banks increases, their multiples generally increase. Now, with a less regulatory overhang facing the financials, and with the potential for interest rates to unlock some of that earnings power, I think that there is a longer runway for the banks. I look at it like tech in 2010. It's just come out from its doldrums, and there's a lot more upside for the sector overall.
So, Mark, how does that pair with your world? So if there's upside, we're going to see better yields, we're going to see more growth. How do you translate that into how you invest in credit?
So, we're a user of everything the street puts out there, and we're seeing a lot of activity in the new issue calendar, in the activity of the street. We're also seeing trading starting to pick up too, so secondary markets are working a bit better. So all of those things end up giving you a tighter risk premium, which we're capturing in here, that sort of rise in prices. But I think overall, though, I mean, the trader in me wants to fade this market, the investor in me wants to love it, right? Because it's moved so much, and the trader wants to fade it. But and so we can do that as an active manager. There are parts of this market that have run single names that have run too much, and we'll sell into this rally a bit, and thinking that at some point when the fundamentals do catch up with the name, we'll buy it back cheaper, because that's the dynamic. So. To the point of what happens in the credit market, when it gets very technical on the positive, everything runs with it. We can sell into some of those names that we think have run too much as a trader. But as an investor, again, I really think we should stay long, not sit on cash, and rotate into things that really haven't moved.
Mark, I'm curious, when you talk about getting active and kind of going in and picking those either particular companies or picking the particular credit,
sure.
This has been an environment a lot of people have waited for to get the kind of dispersion. But so far this year, we've seen money basically going into passive funds. We've seen money avoiding the active managers. What is it about the environment right now that could potentially make this different when it's really been like this for about 3 or 4 months, and stock pickers haven't been doing great?
It's a big setup, right? I mean, we've seen a huge amount of underperformance from active managers, and the way that your normal investor works is they look at their statement. Oh, that's not working, so I'm going to sell that, and they sell at the bottom. So some of this has to come out of the system for this to really start working. But on the other side, you can sit there and look at a trade and say, look, this is all ETF driven, it's way too high, and fade it, right? And then at some point that will start working. And we're seeing that more and more. So the active management activity is starting to pick up. It's not all the way there, but you're starting to see it in the numbers. The numbers from active are getting better versus passive. But it's a big ship to turn. It's going to take a long time for this to really kind of come to fruition. But I think bottom line, it's a better place to be.